Hello everybody, welcome back to the channel. This is Fair Value Finder, and today we're going to do another quick video taking a look at an ETF. This time we're going to be taking a look at QYLD, the Global X NASDAQ 100 Cover Call ETF. You guys seem to have really liked the last ETF video that I did, and this is one that I would actually own. I hold some, and this is one that I like. I like the concept. It's kind of along the lines of what I like to do with my portfolio. So to start right off the bat, we see expense ratio is a little high with 0.6, but it is a very active portfolio. They are selling options against their positions. So there's a lot of manual work that goes into it, which would call for a higher expense ratio. But the yield, the dividend yield of this, they pay out what they make from those options on a monthly basis, and they pay out almost 12%. So it's a very high dividend. It's a little sporadic, but stable at the same time. And if we were to see the actual payouts, you'd see what I'm talking about. So we can go to the holdings and see what the heck do they hold. They are 98% in stocks, and they're pretty heavy on the tech sector. Communication services, they got quite a bit, cyclicals, and then just a little bit in consumer defensive, healthcare, and industrials. But they got all of their top holdings here. We see Microsoft is a very large holding here. That's one of them that has just been on a run ever since we did a video on it. I gave it a hold because it's overvalued for a value play. I don't really see the growth to make it a growth play, but there's nothing bad that would prompt me to say sell. Apple, I have not looked into. If you guys want me to take a look at Apple, let me know. Just comment down below. Amazon, that is one that I do want to take a look at because I feel like that one's been a little beaten down and has a lot of growth potential to it. NVIDIA, we know the story with NVIDIA. It's not a huge holding here. If they're selling covered calls right now, they're probably making decent profit off the large volumes and volatility in the stock. I just made a trade, if you watched my shorts that I posted, where I made $80 off of a trade on NVIDIA. Meta might have some upside potential. After their pivot, that's one that I should look at as well. Google, always a powerhouse. Tesla, kind of the leader in the car industry. PepsiCo, that one's interesting here. Everything else here is tech, and then there's Pepsi. Pepsi, I think I have it down as a sell. It's just twice the fair value price, and it's starting to show the volume and decline. So I am trading against that now. I'm shorting it through call covered spreads, call credit spreads, and it's going to make a little bit of money as it goes down. Nothing too crazy. Then we can look at the chart here and see, because some ETFs, especially when they pay a high yield, it's just straight down. And we see here, I mean, there's a lot of down. They started at $25 back in 2013, and now they're down to $17. And it kind of just seems to be very cyclical and go through waves, up, down, up, down, up, down. But the downs tend to be larger than the ups. And we see the dividends down here, 16.8 cents, 17.3, 16.9, 16.7, 17, 16.1. So it's all in the 16 to 17 range from what I've seen, and just kind of bounces around within those ranges depending on how much premium they're able to collect. Right now, their positions are doing well. That's probably what's really driving this share value, because if you guys haven't seen the breakdown, I know quite a few finance influencers, whatever you want to call them, have been looking at the S&P 500. And if you take out the top 5 stocks, the total yearly change for the S&P 500 is 0. There are 5 stocks who have made all of the gains, and those just so happen to be the stocks that are held in this ETF. And those are things that I personally would not buy. I mean, the market loves them, but if you want to be a value investor, typically you're a contrarian and stray away from what everyone is flocking to, because they'll flock to it now, but once the new thing comes out, they'll hop onto that wagon. The performance of this is decent recently. I mean, it's had a good year. The annual returns, it lost quite a bit in 2022, made a fair amount in 2021. And I mean, the only down year here is 2018, aside from 2022, on the total percent return, because they are paying out a pretty hefty portion to you. Year to date, up 16.88%. That's a nice return when the market's basically flat. And as the market shifts, if you want to find profit, you have to shift your strategy as well. I mean, in a flat market, there will always be value investments that we're looking for, but you can get some money here and there off dividends, off options. They're lower volatility, but you're more likely to hit. And also stock lending, as I've talked about before, where you can just get paid a little bit here and there. I just wanted to take a quick look at this one, tell you guys why. You know, I've talked about how I'm opposed to ETFs, yet this is one that I hold. And hopefully it's something that you guys look into if you're interested in just parking cash somewhere. Because if I hold it in my account, I get 4.5%. If I hold it in here, I get almost 12%. And it's some of the better performing holdings in the market right now that are their largest positions. So if you like this one, please like the video. Again, comment down below whatever stocks you want me to look at. Subscribe if you want to see more like this, and I'll catch you guys next time.